Hi, welcome to another edition of Treece Talk with your host, David Treece. We're happy to be back after a month away with another edition of Treece Talk. My name is Robert Wroblewski, Business Development Manager at Treece Financial Group. We'll be answering your questions that you submit using the Q&A and comments through the chat functions located on your screen. We have a lot to cover today as David dives into details on the financial safeguards in place that help you keep your investments safe. A timely topic after the series of bank closures over the past couple of months. And of course, David Treece's analysis and commentary on the current market, including last month's economic reports and where the market may be headed as we move into summer. Now, DTC, please bring up today's poll. May is designated as Older Americans Month, and this year's theme is Aging Unbound. For today's poll, we asked the question, in relation to Unbound, what is one thing you no longer feel constrained by any longer as you age? Now let's bring on David Treece, investment advisor representative who has been serving your community and beyond for 30 years. David?
Great to be here. Great to be back. I like that question. What you feel unconstrained by age. With me, it's my commentary, my big mouth, my opinions. Somebody else put their waistline. That's great. It has been a while, so it's great to be back. I was traveling. I was in Morocco for like 2.5 weeks. If anybody's planning on going, I highly recommend it. I'm happy to give some travel tips on places we saw and what we enjoyed. So that's a pleasure to be able to travel like that. And Morocco was wonderful. So again, welcome to Treece Talk. And today I want to talk about some of the, obviously the things that are going on with risks in the market about the banks, interest rates, and the debt ceiling that's been in the news, especially yesterday when Janet Yellen said the X date, that is like D-Day, so to speak, when the Fed will literally, or the Treasury Department runs out of money. And that's June 1st, she's estimating. We've already, we're doing these extraordinary measures right now. So this is a political decision. I mean, one of the things, and I'll read some commentary from Cetera and First Trust Portfolios and BlackRock, but this is a political football. This has happened in the past where we've had to deal with raising the debt ceiling. One thing to point out is that we're talking just about paying bills, that the money has already been budgeted, and now it's just time to pay the bills. So it's not about anything else other than failing to pay bills. Now, of course, there may be some agreements about not spending so much money in the future as part of the agreement to raise the debt ceiling, but the debt ceiling in and of itself is just about paying the bills. If the bills don't get paid, it has to do with a default. So I'm going to talk about that a little bit. One of the things that people are asking about is the safety of the banking system. And I feel pretty strongly, as Jamie Dimon from Chase said, at this point, so far, there's no banking crisis. In fact, I'm impressed how well the FDIC is working during these big bank failures, and they are significant, but they are isolated and they're specific cases. And it's understood what's gone wrong with those bank failures. And it is not something that is systemic per se. Of course, the debt ceiling, if that is not passed, and we end up with a default, which I'll talk about, that all bets are off then. That's never happened before. In fact, I'm going to say when I was in business school so many years ago, and still today, we talk about the risk-free rate. And you think, well, nothing's risk-free. Well, short-term T-bills have always been considered risk-free, literally. So if something is, you're earning more on something else, you're earning more than the risk-free rate. So the idea that something would not be truly risk-free anymore is shocking. And we'll see. It's never happened before that the United States has defaulted, but we've played this game of chicken many times. So just getting back to guarantees, people ask about these, the FDIC insurance, that's $250,000 per account. And of course, it can matter how it's titled in different banks. We do believe in the FDIC insurance. We do want you to have it if you've got more than 250,000 in one bank under one title. Then we would encourage you to consider just keeping the 250,000 max. And there are different ways you can title things differently and different beneficiaries. There are ways that you can spread that insurance across different accounts, even at the same bank. Treasury bills, assuming that the United States does not default on debt, are basically considered risk-free. So that's another safeguard. Insurance companies, we always say that it's based on the claims paying ability of the insurance company, but there are often guarantees when you're working with an insurance company. They will guarantee. It could be a certain interest rate, a certain growth, or just a return of principal, but it's based on their guarantee. And so you want to look at the company, their rating, their strength. We are regulated at Treece Financial Group and through Cetera Advisors that we can only work with certain highly rated insurance companies. So, if it's B+ rated, we're not able to work with it. It has to be higher and approved by our broker dealer, Cetera Advisors. Also, there is, in the relatively unlikely event that an insurance company fails, and I'm talking about life, health, annuity, that sector of the market, then there are state guarantee associations. In Florida, it's generally 250,000, just like the FDIC limit. Now, on the property and casualty side with hurricanes, those companies are far more likely to fail, and they have failed. On the life, health, and annuity side, it's much less likely. We have far less history of that happening. And for us, because we're working with higher rated companies, it's extremely unlikely. The SIPC insurance is $500,000, including $250,000 of cash, and that's for broker dealers. So that's if a broker dealer should fail, and you've got cash there or securities, there's coverage there. And again, some smaller broker dealers definitely have failed. Larger ones, it's not that common. Guarantees on annuities, again, because these are issued by insurance companies, so you've got the same guarantees there. I want people to understand that. And there are other safeguards with some of these. I had this come up just yesterday. A client was asking about what assets are protected from creditors. And this is a little bit different because we're talking about guarantees from either the government or an insurance company. And we also have guarantees also from the state. We have guarantees against creditors in certain situations. And I've had it come up where somebody once caused a car accident, was being sued, or people have to make a decision to not throw good money after bad and go through like a bankruptcy. That happened 2007, 2008. People who bought tons of properties and they let them go. And so there are certain protections there in Florida. Your homesteaded property, money in retirement accounts like IRAs, 401ks, the cash value of life insurance, annuities. Generally, all of these things are free from creditors. So that also can be an important financial safeguard for people. One of the things, it's certainly not a guarantee, it's not a safeguard, but it's like a risk management tool, is we work with investment managers, money managers who will reduce the risk themselves. So they're watching the accounts and they will make a decision. This has gone down too low and there's too much risk, and we're going to reduce our positions. And I kind of like that. I like again, it depends on your risk tolerance and your time frame. But for most people who are in retirement, with the extreme ups and downs we've had, especially from the pandemic, but during a normal lifetime of a normal retirement time frame, could be 10, 20, 30 years, there's going to be probably some severe period of market losses. And so the idea is to try to control those through the reducing risk in the market. And of course, combining these things, that's something we've absolutely done. We encourage people to have money safe and liquid in the bank, emergency money, and then we'll work with all of these other ways to control money, helping people with CDs or insurance products, the money managers that go to cash. There's it's just some interesting, things here about the debt ceiling. One of the things is, here's, I guess, a little bit of trivia is people talk about treasury bills, treasury notes, treasury bonds, and the treasury bills are basically the short-term, less than a year investments, and you get your interest at the end of the term. And then you've got the treasury notes, which are generally like 10 to or 1 year to 20 years, and then the bonds are longer term, like 20 to 30 years. Those pay interest every 6 months. So you've got treasury notes, treasury bills, treasury bonds, and but they've all been backed by the full faith and credit of the United States government, which has meant a lot historically. So here's some commentary from Cetera. The debt ceiling has been reached and the clock is ticking before the U.S. will miss payments on its obligations. Market fluctuations will likely worsen as political brinkmanship could last until the last second. And we always say we don't want you to position your portfolio on headlines. That is, if there's something in the news, often it's just very short-lived, 2 or 3 days, or it's a risk that really doesn't develop. And of course, here we're trying to position you in advance of what may happen, the way that we're managing money here at Treece Financial Group. So the United States hit the debt ceiling back in January. This is an important point. And the Treasury Department is using what they call extraordinary measures to continue paying government operations. It estimates that these measures may not be sufficient to continue paying obligations as early as June 1st. So again, the clock is ticking. We've got about a month to go, a little bit less. The debt ceiling is the maximum amount of debt the United States government is authorized to borrow by law. While Congress has already authorized spending commitments, that was the point I was making earlier. It's like we're just agreeing to pay the bills. We're agreeing to pay what we have spent. And so the US government is spending more than it receives in tax revenues, creating this deficit. To pay for the deficit, the government must issue more debt, treasury bonds, but the maximum amount of debt written into law has been reached. Approaching the debt limit is not unprecedented, and the Treasury Department points out that since 1960, Congress has acted 78 separate times to permanently raise, temporarily extend, or revise the definition, Congress, of the debt limit. And this time does feel different. However, this is Cetera's commentary, as COVID stimulus spending caused debt to GDP, so that's the ratio debt to GDP, to surpass World War II levels, and congressional divisions seem deeper. Defaulting on the debt and not making payments on commitments, however, is more unprecedented. They say more unprecedented. No, it's totally unprecedented. It's never happened before. So the debt ceiling is important because failing to raise the debt could cause the government to not meet legal obligations such as paying Social Security, Medicare, and interest on the debt. If Congress disagrees on a debt limit, that could lead to a default on U.S. treasuries, making countries less willing to buy America's debt, the bonds, treasury bonds. In 2011, a credit rating agency downgraded the U.S. from AAA to AA+, partly due to a debt limit battle. So that was, again, not because of the inability to pay, it was the willingness to pay, a political decision. If a default did occur, the government would likely delay payments to bondholders, but it would pay a steep price. The ramifications would be huge. Some say catastrophic, and we've never been through this before, so we don't really know what all the implications would be. Potential downgrades of U.S. debt by rating agencies, elevated levels of market volatility, and a worsening economic situation. Furthermore, what cannot be measured is the indirect effect from businesses. With uncertainty in Washington and its potential effect on the economy, business leaders may be reluctant to increase capital expenditures or hire additional workers, both clearly not a good sign for the economy. And basically what we're saying is to wait it out. Nobody's predicting default now exactly, but nobody knows what it's happening. So we say that according to Cetera, increased uncertainty combined with below trend economic growth will likely lead to market fluctuations. And we just have to plan for that. Again, generally, nobody's expecting that there will be an actual default. And they're already talking about just reaching some sort of a temporary agreement. So here's where we are now. We have this week, tomorrow, the Fed is meeting to probably raise interest rates again, another 25 basis points or 1/4%. That's what the markets are pricing in. The latest odds are 96%, despite all of the recent banking sector turmoil. The Fed remains focused on inflation, though tomorrow's likely rate hike could be the last one of this cycle. We've heard a lot of commentary saying that the rate hikes are working, the economy is slowing down. So we're seeing all sorts of signs that we could even be going into a recession. And so at some point, the rate hikes are likely to stop. And we're thinking a lot of the conventional wisdom is that tomorrow is maybe the last. Of course, it's all data dependent. It depends a lot on what next readings we get on inflation in particular, plus other economic measures like GDP and unemployment. Right now, there is a meeting scheduled May 9th between President Biden and Congress. And we're expecting a short-term debt extension could be a likely outcome to avoid a partial government shutdown. But time is short because Congress is not even meeting the whole month of May. They'll be adjourning earlier. So hopefully something will be coming soon. Just to recap the markets, but obviously the markets are still down from the previous highs, and as up from, down from last January when we started this, correction. The Dow is up slightly this year, but just 2.73%. Again, that's only 30 stocks. The S&P 500 is up 8.55%, and the NASDAQ is up 16.68%. But of course, the NASDAQ was down over 30% last year, so we still have a ways to go. This is a commentary from First Trust, and this has a different point of view. So there's some things here that are contrarian. In spite of weakness in some economic data, problems in the banking sector, and much higher interest rates, real GDP in the first quarter will almost certainly show moderate growth. And the S&P has come up from its lows last October. And now many are starting to believe that we may avoid a recession. A lot of the commentary is that there will still be a recession, but it may be short and shallow. They are predicting that a recession is coming, and they blame this on the Fed spending so much money back in 2020 and 2021 during the pandemic. Under two different presidents, that Congress passed out enormous checks to try to smooth over damage done to the economy by the COVID lockdowns. Inflation has been the result. Now both fiscal and monetary policy have turned tighter, and we're talking about the unprecedented nature of what happened and how it's affecting the economy. Obviously, we're still working through all of what happened there. Most importantly, recent data show some early signs of weakness. Jobless claims have risen. Manufacturing production in March was lower than a year ago, and real inflation-adjusted retail sales are down from a year ago. And they agree. We think the futures market is correct in anticipating another 25 basis point hike in May tomorrow, and just like they had predicted, and we saw February and March. Here's where they are contrarian. The markets are not as prepared for another rate hike in June, which we think is more likely than not. So again, that's a complete possibility that the Fed will continue to hike rates slightly if the economy still remains relatively strong as it is, and if inflation remains persistent, as is somewhat expected. Inflation remains a problem, and the April inflation numbers arriving May 10th, that's next week, should confirm that problem. The federal funds, this is an interesting point, the Fed funds futures market expects the Fed to end the year with short-term rates lower than they are today. They're predicting that they will end up higher than today at the year end instead. I do see longer rates that are being offered on longer term investments are lower than where they are now. So at some point, the market is definitely pricing in lower rates. So that's not right away, but it's interesting to note that, for example, if you have investments that are offering 1 year, 3 year, 5 year, the 5 year rates are going to be lower, possibly lower. maybe the same, but it's like, why would you lock in a lower rate for a longer period of time? And the answer is that those investors are thinking that rates are going to go lower. And so they're going to lock in what they think is a better rate now for a longer period of time. Here's a little bit more commentary. They're also asking why the markets are thinking that we will get rate cuts later this year. The next key inflation print, the consumer price index for April, they predict will come in hot. And the same time, longer term bond yields are drifting down, stock prices have been rising, that this is not a tightening of financial conditions. So again, we do see this. Sometimes it's like we keep getting good economic news, and that's like, okay, bad for this issue of the Fed having to raise rates and controlling inflation. So again, it's very, very data dependent. So we'll see. This is from BlackRock. And again, they also are saying that they see the rates going up right now, but they also agree with First Trust. We don't see cuts this year. We also expect U.S. jobs data to show a tight market still fueling wages. That's one of the things that the Fed looks at is wage inflation. That is, if the unemployment rate remains low, then often that causes wages to go up, which is very inflationary. Looking at the market, U.S. stocks rallied from a 4-week low last week after tech earnings beat expectations. That's another one of these things that came in positive. And that also helped offset concern about regional banks. And here we're seeing that the consumer spending is losing momentum over the course of the first quarter. Strong U.S. wage growth points to inflation settling well above the Fed's 2% policy targets. That's why they believe the hopes for rate cuts this year are misplaced. So again, we just have to kind of wait and see what the market is going to do. Now, to wrap this section up, on the banks and the risk there, the FDIC seized First Republic Bank on Sunday and reached an immediate $10.6 billion deal with JP Morgan to acquire all of First Republic's deposits, the majority of its assets, and assume most of its liabilities. This deal marks the third federal seizure of a regional bank since March. Now, one of the interesting things is when this happened, the stock market did not bomb, it did not go down, it did not react negatively. Moreover, Chase actually got a bump in its stock, and during the day when this was announced. So this is again one of the things that I think the FDIC is doing well, and it's moving smoothly. Is they're seizing these banks, taking control, and making there's not more of a risk in the market. And these are specific cases. And they're also talking about raising the FDIC insurance limits beyond the $250,000 for businesses, so further protect business deposits rather than individual deposits. So that's my commentary. And I guess we're going to go on. Maybe if we've got any questions, we can try to answer some of those questions.
Thank you. If the FDIC is a part of the larger part of what the government has constructed is trying to protect the banks, and if the banks are paying into this FDIC insurance, is it one that we should, as people, be concerned that when a bank collapses, that we should be affected as depositors as well, because the FDIC insurance is going to go down because a bank has to be rescued from FDIC?
When you look at 2007, 2008, I remember how I thought brilliantly the FDIC stepped in, and there were just huge losses that the FDIC was covering. But it was done so brilliantly. And I remember, I've said this before for people who've listened to me before, that it was like 5 o'clock on Friday, the bank would close and then reopen on Monday, which is just what happened with First Republic. It was on Sunday that they were negotiating all of this. But the FDIC is, part of our government, and we definitely think that this is supported, and it's kind of like if an insurance company fails within the state, what happens there is the state will go ahead and assess other insurance companies to make up the difference. So I don't see that the FDIC is at risk of failure, which I think was the point of the question. If the FDIC fails, it's one of those things that's like too big to fail. It's like if the government fails, and of course this happens in other countries. And this is one of the times, and again, my background, with my husband from Argentina, and we were there when everything failed. And I mean, the banks closed, and we had like 5 presidents there in a week, and the money got devalued. So the other countries live through things, even right now, 100% annual inflation. And so, these things have not happened, and certainly in modern times in the United States, and we don't expect them to. But yet, there's like a first for everything. And it's just unimaginable. It would be so monumentally historic for the United States to have this self-inflicted wound of not paying our bills. And that's how to look at it. Now, of course, others may argue, well, at some point we can't sustain this level of debt. And that's not really an issue right now. A lot of this, always you see like the psychology behind a bank run. A lot of this has to do with confidence. That right now, there is still enormous confidence in the United States and in our systems, despite all of the political divisiveness. Now, if that should change, it's hard to predict, how bad it would be. Right. And strangely, even when we had our debt downgraded, there was still like a rush to safety, which was the United States. And we benefited from that instability in a weird roundabout way. And that happens internationally. Unfortunately, if there are problems elsewhere, like has happened with Russia invading Ukraine, not that it's intended, but there's a rush to safety in the United States and like out of Europe. So, but here, if all of that's just blown away, what will the world look like? And that's hard to predict. But right. To get back to your question, right now there is no reason to doubt the FDIC.
And to that point too, also globally, the United States is still very strong comparatively to other countries.
That's absolutely been the case. That we do think that there's room for international growth. But the United States has been leading the way. When you travel abroad, it's interesting to talk to other people, and they'll say what we know is that it's like when the U.S. sneezes, the world catches a cold, and the influence of the United States, the size of the economy, and of course, a lot of it is not just the systems, but it's the real the value of the dollar. And the one funny anecdote I remember, again, going to Argentina, everything was like measured in dollars. And you can go to other countries, even tourist areas, and they'll accept dollars. It's like you would never, if you've got, Argentine pesos or even Japanese yen, even a mainstream currency, you wouldn't expect to be able to tip with it in another country. And somebody in Argentina once asked me, so, well, what's the dollar worth in the United States? And it's like, well, a dollar. It's like, the idea is like thinking of it like gold, like it has a value that is used as a worldwide measure. And of course, other countries do use the dollar as part of their economic, that's Ecuador, Zimbabwe. So it's like the dollar is in circulation. So to not have the dollar as a reserve currency, or not have the full faith and credit of the United States to pay debt, or to the U.S. to default, it's something that happens in other countries, third world countries. But that's one of the concerns, is that the United States keeps having things that have never happened before, but it's a matter of responsibility,
right? And keeping that risk-free rate intact. We have another question here too. Is the lesson of First Republic that generally banks that cater to lots of middle-class customers are safer than banks that focus on a smaller universe of bigger depositors?
First Republic had a lot of wealthy holders, so that was also possibly very profitable eventually for Chase. And I think the big issue here are the too big to fail banks, because you do have these very, very large banks. And I think there's a lot of truth to it that unless there is some specific mismanagement reason that one bank goes under, it seems like Congress will step in, and that is prejudicial to some extent to smaller and mid-sized banks. It's a consumer can say, I have extra protection being with one of these super large banks because they are too big to fail. And we see certain behavior, for example, I mentioned insurance companies that are like B+ rated. They often have to provide higher interest rates to their contract holders, partly to offset the fact that they're not as highly rated. And so I think I can't say that there's more risk. I think anybody who is under the FDIC insurance limits, whether they're at a smaller bank, and also the credit unions have something similar, 250,000. I think as long as you're within those limits, you're probably going to be fine. And normally you don't want to have to deal with this. However, it's been done so seamlessly that, in other situations, for example, I think like insurance, if you've got a property and casualty company, a hurricane in Florida, you basically you're going to go through a process, a system, working with the government. But for the bank holder, the bank customers, it's been pretty seamless. So as long as you're with that FDIC coverage, which I think is incredibly valuable, I think there's not a reason to worry.
David, just one last question here too. With the debate and the juxtapositioning with the debt ceiling, there is some ways that the Republicans and the Democrats are negotiating, and there's going to be cuts potentially made, part of these negotiations, if it happens this way. In your opinion, what are some of the things that we can look out for, and some cuts that we should just not stand for as citizens, saying that this is not something that we should go for, we should accept?
One of the things that this has been studied about the deficit, and like all of the like the P. Peterson Institute, all of them are saying that there's no easy solution, and you can't do it just on one side by raising taxes or by cuts. It's going to be a combination of both of those. One of the topics has been Social Security and Medicare, the entitlement programs. People sometimes don't like that word entitlement, but what it means is you've paid into the system and you're entitled to these benefits. It's that these systems, I kind of a strong opinion that we rely on them too much, particularly the Social Security for retirement. We've gone away from pensions, and this is a pay-as-you-go system. It is true that there's not enough revenue projected in, I think, 2034 to pay 100% of the benefits. It'll be like 74% of the benefits. We've been through this before, and this is definitely solvable. It takes some political will, and it could be like what's going on in France, where you have to raise the retirement age, which has happened. We went to 67 for those who were born 1960 and later to get 100% of their benefits. It could be extended again. It could be a tax increase, because right now the taxes that you pay into the Social Security system are capped, and it could be higher earners are going to have to pay more taxes into the system. So there are ways that they can adjust the benefits. It is a question of political will. What are we going to cut, and are we going to increase taxes? And so these are parts of our planning for our clients. In all honesty, we want people to not have huge tax burdens in retirement, and to plan for maybe tax-free income or tax-deferred income. That's where we take advantage of the laws, the traditional IRAs, the Roth IRAs, but it's an issue that we have this enormous deficit. Of course, we went through this before, after World War II. And you can compare COVID maybe to this idea of there was a time when the government just had to engage in extraordinary spending, but it is that we can get back on track and pay down some of the debt. But this is all about political will. Some of the other issues involved is the level of commitment. And you look at artificial intelligence and all the disinformation and concerns about that and what people are going to believe. There are other risks out there. It's like every time there's something new, we tend to get back on track, no matter what happens. If it's the tech bubble, if it's the Great Recession with the housing crisis, if it's a pandemic, World War II, now war again in Europe. So we can solve our problems. I think that's a fair statement. And will we is another issue. So time will tell. And of course, we've got elections next year, which people are not looking forward to in terms of all of the acrimony. But I say just try to be positive and focus on what you can control.
Thank you, David. That concludes our Q&A session.
I think I'm going over again. So I think that's all I have. I think unless I'm missing something. We are going to have other Treece Talk in 2 weeks. And we're also going to have a special guest in June, Andrew Bellinson, who is an elder law attorney. In fact, I just gave a referral to him from somebody who needs help with a special needs trust. So we're going to be addressing that. This has to do with trusts, with Medicaid, government benefits, setting up income to preserve government benefits if somebody's getting something like Medicaid, not Medicare. And we have all sorts of other good things happening. I won't go into it. We're going to have probably special sessions on some of our major projects that we've been talking about, like our solo ager program. And I'm also doing some writing. So, and that's it. At that point, I guess I will wrap it up. Old age is an excellent time for outrage. My goal is to say or do at least one outrageous thing every week. Maggie Kuhn, founder of the Gray Panthers. I remember them well. And I do that sometimes unintentionally. It's something outrageous. That's it. I think we're all set. I think we saw our poll results. And again, thanks for joining us on Treece Talk. Good to be back. And we'll see you in 2 weeks.